Hello and welcome to this Friday's morning market briefing. We've got a lot to talk about, but firstly, the US economy does grow by 4.9% in its third quarter this year, as well as that the ECB does hold interest rates at 4% in yesterday's meeting. And we've got lots to talk about on the charts also, with lots happening on the economic calendar as well, but we'll come to that near the end, so make sure you stay around till you see that. But firstly, to talk about, of course, is the US economy. Now, the US economy expanded faster than expected in the third quarter, growing by its quickest pace in almost 3 years. Now, this is a topic that we've been talking about a lot recently, mainly the fact that the US economy has been a kind of a bright spot within the global economy, which has been suffering recently as a result of, coming out of lockdown, having its high inflation as a result of supply side issues, and then also then having to deal with the new high borrowing costs from these interest rate hike decisions, as well as that, issues within China as well, for example, has stunted growth in many other nations as well, especially with manufacturing, with them not being able to get those important goods that are needed for production. Now, this comes despite interest rates being at their highest for years. So this is, once again reaffirming the kind of message and idea that the US economy is a bright spot within the global economy, but also that it's a very strong and resilient economy, which it's a great struggle for the central bank to essentially keep the US economy growth down by using interest rates. It's clear that that doesn't really work for the US. It has such a strong labor market at the moment that it's really hard to keep growth down. With the GDP figure reaffirming the belief that the US economy is a bright spot of the global economy, and adding to the signs that it's increasingly an economically resistant nation, with high consumer spending being the main driver of the 4.9% growth. So once again, this is reaffirming the message that interest rates aren't doing the job that they're kind of needing to do, because if interest rates aren't having the effect that they're supposed to, which is to halt consumer spending, then it's quite a possibility that rates need to go higher still, which is obviously going to have its effects on numerous markets. Now, the figure was a jump from being the 2.1% figure that we saw in quarter two of this year, and came above expectations of 4.3%. So, coming in quite high above expectations, quite significant 0.6% there, with consumer spending up annually by 4% in comparison to the 0.8% we saw in quarter two as well, with strong growth shown over both the goods and services sector. And this is building on the data that we saw come out earlier this week as well. Maybe on Wednesday it came out, but this was the data which showed that the US economy, especially in regards to manufacturing and its service sectors, was doing better than economists were expecting. Therefore adding to this image of the US economy being a very strong economy at the moment. Now, this data comes as the Fed preps for next week's meeting on interest rates. But that said, the GDP figures are unlikely to affect the decision much, as they are more backward looking in comparison to monthly data such as inflation and payrolls. And we know, although that's an important thing to note, at the same time, inflation and payrolls have been adding to the same messages that this also does, add to. So whilst I would more so agree with that kind of statement around it, the data being less relevant due to the fact that it's quarterly, although that's true to some extent, it's still not the same in regards to current data, because current data, monthly data, is in line with this overall message which this data also presents. And so I think it really does just reaffirm, the continuing message that we are seeing from, the US's economy, which is that it's remaining resilient despite high interest rates. with the Fed expected to hold rates where they are to give policymakers more time to assess the effects of the prior rate increases and events. And this was rhetoric that we heard since, since the Jackson Hole meeting. When they did talk about holding rates where they are, just until they're able to see how the rate hikes that they've already done so far will affect the economy, because obviously it takes quite some time for the effects of high interest rates to really set in within the economy. So that's what they're largely waiting for. Now, initial market reactions to the GDP data were muted, with small dips in bond yields and a slight uptick in stock market futures following the data release, and we'll come to the charts near the end, so make sure you stay around till you see that. With investors now betting there's only a 27% chance of another rate hike this year, which is quite low, considering everything that's really adding to the overall message that the US economy is resilient and resistant to these upticks in interest rates. That said, what we then see from the data in the next few months will be heavily influential, because they're really waiting to see what's been the effect of interest rates so far. And once they understand that, that's when they'll really make their decision. So that's what we're really looking out for in regards to how that will affect the Fed's decision. And now this is the decision to hold rates where they are, which is expected, is largely based on the presumption of the Fed focusing on the hard hit sectors by high interest rates, those being property, for example, which has really taken a downturn since the high interest rates, obviously because it causes mortgage rates to go up and makes it harder for people to buy houses, reducing the demand and driving prices lower as a result. That said, though, consumer spending is resilient, so the chance of a rate hike is still there. So definitely keep your eyes on the topic of the US economy. But next to talk about, of course, is the ECB, which holds the key interest rate at 4%. Now, the ECB kept rates where they are, ending its streak of 10 rate hikes. And this has been, the theme now across all the major economies, really, with the US ending their consecutive streak of rate hikes, as well as the Bank of England. So it does seem that, these major central banks have now reached their peak, or if not close to their peak, for interest rates going up. Now, this comes as concerns continue to mount over Eurozone growth. And this has been a topic that we spoke about when we also spoke about the US economic growth data, with, whilst the US was seeing, upticks in its manufacturing and services industries, coming in above expectation, the Eurozone economy was coming in below expectation, doing worse than expected. And this is largely in relation to their manufacturing industries, with their automobile industries obviously taking a large hit from these higher interest rates, as well as, the numerous supply side issues across the world. And as well as that, the high interest rates have really taken a toll on consumer demand, with people really just sticking out with the current cars that they have and not looking to get new cars, as rates are so high at the moment. It makes it hard to kind of finance that sort of purchase. Now, this decision was expected, considering inflation is now half of its peak level, whilst the economies of the Eurozone have been weakening dramatically. And this is why we were kind of expecting more of like a dovish position by the ECB's president Lagarde, because of this weakening Eurozone economy. This is kind of why we kind of felt that way, with the interest rate staying at 4%, which is far above its all-time low of minus 0.5%, which we did see during the lockdown period. This decision comes ahead of the decisions by the Fed and the Bank of England next week, with these two central banks also expected to hold rates steady. As I said, it does seem that rates are near their peak, or at least central banks are holding them where they are until they get a better understanding of where the economy's at, how it's being affected by the already raised rates and that sort of thing. Now, Despite the decision today, despite the decision yesterday, the ECB's President Lagarde told in a press conference that she would not rule out another rate hike, with it being too early to discuss a rate cut. However, Lagarde did put a dovish slant on the decision, stressing how much prior rate hikes were already squeezing activity, as obviously, the higher rates have been squeezing manufacturing industries and the German economy greatly, with the Italian political situation being heavily damaged, and becoming very distant with the kind of EU institutions as a result of these rising rates, with Giorgia Meloni categorically opposing these higher interest rates, with Lagarde also saying that she was being very attentive to the tensions within the Middle East, as this is something that we've been covering a lot recently, especially in relation to the potential of regional escalation and the damage to oil prices, and the adverse cost to inflation as a result of that. Now, concerns are mounting over the higher inflation that we're seeing within the Eurozone, as well as the weak growth, and analysts expect GDP figures for the third quarter to show a contraction in output next week. And inflation is currently at 4.3%, but some economists expect the figure to be published on Tuesday next week to be closer to 3%. So actually quite, decent inflation figures, considering all that's at play at the moment for the European economy. But that's all to talk about in the articles, really. Definitely keep your eyes on that. But next to talk about, of course, is the charts, where we've got lots happening, with firstly US indices falling to the downside today, in line with expectations for higher interest rates as a result of the GDP figures that we did see. Because obviously, if GDP figures come in above expectations and inflation is high, it's likely that investors are going to begin to expect a rate hike decision, as higher levels of GDP growth give the Fed a greater level of leeway in rising rates, as they know that if they do raise rates to bring down inflation, it won't hurt the US economy that much, and so they're kind of more so able to do that without the fear of much consequences. And that's why we've really seen that sell off today, with yesterday the US 30 being above its prior highs, prior lows made earlier this week. But following the data release, we did see that sell off and break below these prior lows, even breaking below the lows made at the start of October. And now we're venturing into levels not seen since June of this year. So it'd be interesting to see where US indices do go from there, because we are seeing the same across all US indices, with the US Nasdaq being hurt the most by the GDP figures, it does seem, now breaking below even the lows made in May of 2023. So the Nasdaq is really taking a significant hit at the moment, and really making a move to the downside, as rate hike decisions are expected even more now. Now, the next to talk about is the dollar, of course, which has moved up into this area of liquidity now. We had spoken about how, I believe it was the manufacturing and services data that we saw earlier this week, which drove the dollar to the upside and allowed it to break above this bearish trend that we were kind of forming. So it took the liquidity from the double bottom, moved to the upside, broke and rehooked onto that trend line that was bearish, and changed the trend to the upside. It is now broken above this level that we had highlighted as a potential area of resistance. That said, although it's broken above it, it has kind of come back below those prior highs in an act of consolidation as a result of the strong area of resistance there. So it'd be interesting to see now whether the dollar can make a push once more up to these areas, this fib extension area that's noted quite some time ago, but this area of liquidity, this area of resistance and prior highs for the dollar, as a result of having this GDP figure come out and reaffirm kind of this idea that the US economy is very resilient, and so interest rate hike decisions further may be required to kind of calm down the economy. So definitely keep your eyes on that. But that's all to talk about on the dollar. Next to talk about is Euro USD. So still on the topic of the dollar really, but yes, Euro USD has continued a kind of movement to the downside going into this week, and now it's kind of consolidated off today's news, and that's kind of as a result of having these two conflicting so many messages within the markets in relation to the euro dollar pair as a result of the US economic data coming out in relation to its GDP, and as well as the ECB's interest rate decision, and so it's kind of created a kind of area of consolidation on Euro USD. But I think going into next week, when we'll start to see the Fed's decisions, which will be driving a lot of dollar movements, that's when we'll really be seeing where Euro USD does go from here, as we have heard the rhetoric now from the ECB, and now next week we should hear the rhetoric from the Fed. But next to talk about, of course, is pound yen, which has seen a bit of a bullish move today. Some bullish momentum to the upside after once again reaching this strong area of support. It does seem this strong area of liquidity to the upside. It did come down, punch into that area, find its liquidity, and move once again to the upside. That said, you could see this as a retracement move. We had this area marked out as a strong area of support and then resistance and liquidity for pound yen, which prices reacted to many times. As well as that, we have the 61.80 Fibonacci level stuck in there. So it could be argued that price may move into that area and react in a bearish motion to move to the downside going into tomorrow. Going into next week, as we do have the Bank of England's rate decision next week. So definitely listen out for that, as that will heavily push the markets. But this is definitely an area to note on the charts. Next to talk about, though, of course, is USD JPY, which has finally, broken above these prior highs, which we had spoken about as a strong area of resistance. This entire pocket here, we said there was a strong area of resistance as we had tried to move up to it, reacted to the downside from it, tried to move up to it again, kind of pushed slowly into it, in an almost consolidation manner, really small bars, really just trying to move into it, but strong sell side resistance before it did find the liquidity to the downside, hitting this 50% Fibonacci area, before now pushing to the upside and reaching that Fibonacci extension level, breaking through this strong area of resistance and liquidity. And so it'd be interesting to see now where USD JPY can go, as it has seen now such a strong movement to the upside following its break from this area of liquidity. So definitely keep your eyes on that. But next to talk about is gold, which still has not reached the $2,000 mark, and it's still kind of in this sort of range, despite having the ECB's rate hike decision rate decision today. But it does seem that we're waiting on the Fed's interest rate decision next week before gold makes any moves. The geopolitical tensions within Gaza and Israel haven't really changed from where they've been now for the past week, and so it does seem that gold will be staying where it is in relation to that. And we still haven't received that Fed interest rate decision, and so that's why we still haven't seen any moves to the upside or downside on gold. So definitely keep your eyes on that going into next week when we have the Fed's interest rate decision. But next to talk about, of course, is oil, which yesterday we did talk about potential upside movements for oil after it did hit this 78.6 Fibonacci area and make a significant move to the upside, but it has reversed on itself once again, kind of rolling off this small area of liquidity that was formed after we broke below this channel. It did move up into that area and react in a bearish manner to the downside. So it'd be interesting now to see where USD JPY may go, as obviously it hasn't broken below these prior lows, but it hasn't been able to make any moves to the upside. So quite possibly we may range on oil until geopolitical tensions within Gaza and Israel kind of change somewhat. So possibly, the invasion of Gaza may push oil to the upside, or some kind of movements back by the IDF forces in Israel may also trigger a move to the downside. So definitely keep your eyes on oil and geopolitical tensions in relation to that. But that's all to talk about in the charts, really. Lastly, to talk about, of course, is the economic calendar, with Chinese industrial profits coming out today, so definitely listen out for that, as well as French consumer confidence, Spanish GDP growth rate, as well as Italian business and consumer confidence data. So lots of Eurozone economic data coming out, which is obviously very important for, adding to our image of where the Eurozone economy is at and where the ECB may be moving with its interest rate decisions. Although we did have the interest rate decision already take place yesterday, this data will still be adding on to what people are now expecting for their next decision, which is, always the way it works with markets. As soon as that decision's, taken place, as soon as that data's out, we're always looking to the next bit of data. So definitely look out for those those few announcements, as well as that we've got US core and normal inflation. So, very important data to listen out for then. This will heavily push gold, as well as influence what people then expect for the Fed's interest rate decision next week. We are expecting lower levels of core inflation. That's the key one to look out for in relation to the Fed, as that's what they kind of base their decision on. So definitely look out for that and see whether we do come in above or below the forecast, as that will heavily influence gold and any US related indice or the dollar as well. As well as that, we've got US personal spending data coming out, along with 2 Fed official speeches and US consumer confidence. So lots of data coming out today. I hope you have a great trading day. Enjoy your weekend as well, once this trading day is over. And yeah, I'll see you next week with the next weekly morning market briefing next week. So I'll see you later. That's all from us at Wildwood Capital. See you later. Bye.